Well, good evening, everyone. Welcome back to the channel. So tonight we have the engineer back on audio only, not visual, but the audio is awesome. We just practiced a little bit before we went live, so I'll go ahead and let you say hi to everyone.
Hello, everyone.
And that was easy. So we're going to talk about rec shares tonight and compare rec shares to YieldMax. So a few things that I understand, I'll just go through what I understand first off from the extensive research that I've done or not. So there's a lot of similarities. The prospectuses, from what I've from what I understand, are identical, and the covered calls, 5 to 15%, are like a week out of the money covered calls based on it off of a synthetic position. They've not been approved for anything at the moment. There's going to be some riskier choices and some value plays that YieldMax doesn't have yet. So there's going to be some funds that YieldMax doesn't have. And then, of course, I'll probably save these for a separate video, but the QQQY and the JEPY and those, we talked a little bit about those last time, but can't cover everything in one video. So anyway, so engineer, I'll let you talk about these funds and rec shares also. So if you want to go ahead, yeah.
Sure. So about 2 weeks ago, someone posted it to your Discord, and I sat down and read through the prospectus. And
Mhm.
my initial thought was like, "Oh gosh, copying is an excellent form of flattery." Um, as far as I can tell, they are trying to copy YieldMax's strategy exactly. And I would invite your audience to find a difference. And I only gave it like a once through. I wasn't super thorough with a fine-tooth comb or anything, but I was like, oh gosh, this looks like they just copied the prospectus just straight over and changed the names.
Yeah. So I was on the website before we went live, and I did subscribe, so they'll send me emails. And I think somebody actually posted the contact info for someone there on the Discord. But I see this microsectors by RecShares, and
Okay.
I was reading a little bit. The website has like the bios for the team, I guess. But these microsectors are 3x, I guess, bullish and bearish. Gold ETNs, and the tickers are SHNY and DULL. It's an interesting
Okay.
ticker for ETN. Sector specific exchange traded notes, and these are what they're touting here. They're targeted, leveraged, and inverse. Beta is 1 times or within an acceptable range, and then they say they're efficient. And then I guess they have them for all of these. These are the product suites here: gold, energy, travel, oil and gas, the FANG stocks, which, it's funny. There's a new term now. They're not so much called like FANG stocks anymore, but I've heard this term called Matana because they've
Okay.
changed, obviously, Meta,
Yep.
Amazon, Tesla, Apple, Netflix, and what's the other A? Alphabet.
Yeah.
Yeah. So anyway, so that's what the site is showing. So let's just check this one out. And yeah, go ahead and keep talking. I'm just gonna look
Sure.
around
So
here.
so when it comes to the difference between the two funds, I'm expecting the differences in performance to come down to experience.
Mhm.
I can tell just by listening to his interviews that Jay is extremely experienced and knows what he's doing, and
Yeah.
he's very confident in his strategy. So
Mhm.
I do not have the same confidence in the other fund just because I haven't heard them come on and do interviews yet.
Mhm. Yeah.
It's totally possible they are just as competent as Jay is, and the returns will be basically similar or identical.
Mhm.
And so you can even view this as a way to spread out your risk. Where so by these actively managed funds, they have human error as a risk. And so instead of putting all your money in Tesla, you can put like half of what you would put in Tesla into the RecShares version of Tesla. You should get basically similar or identical performance, and you will have cut your human error risk in half.
Interesting.
Saying you cut it in half isn't quite ideal. You will have spread out your risk.
Mhm.
Yeah, I heard somebody complaining on the Discord that their pictures were all fuzzy and blurry, like somebody photoshopped them to look just a little bit nicer.
Whose pictures?
I'm not sure. I think they were saying someone involved in the rec shares that
Oh,
the photos had obviously been touched up by a professional to look just a little bit better.
oh, okay. Yeah, it's easy for me to fall behind on the Discord. Sometimes I'm not in there for like a day or so, and you all are chatting away in there.
Yeah, it's a busy place. I check in on it maybe 2 or 3 times a day, and
Hmm.
there's constant conversation for me to check in on. It's a good place for me to go to when I want a psychological break from writing or whatever other work I'm doing.
So this is an interesting comment here. So everyone in the Discord seems like they've been chomping at the bit for a rec shares video. I thought I was falling behind on the whole rec shares thing.
Well, maybe you're ahead of the curve.
Well, good. That's how I think I was that way with YieldMax. So,
Yeah.
well, Tesla had been public since November, but let's see here. Who's this? Is this another channel here? Passive Earning Ideas. He says, funny, I just found a strategy for SOXL and TQQQ. Weren't you talking about SOXL earlier?
So yeah, I wrote a couple articles on if you get a hold of these triple leveraged ETFs and you short both of the ETFs, because of leverage decay, they just both erode for the most part.
Hmm.
If you are in like a ranging market where behavior is normal, both sides of the position will lose money. But if you're in a really strong trending market, your one side will gain not nearly as much as the other side loses, and the net position will lose money.
Hmm.
So shorting both sides of a triple leverage ETF is extremely appealing if you have confidence that the near future is going to be normal behavior.
Right. So this is another channel here, Passive Earning Ideas.
Could they explain to us the gist of the strategy?
Do you want to come on, Passive Earning Ideas? I'll post the link. Let's see if I can find this channel here.
And if you don't want to come on, you're welcome to just type it out in the text.
Yeah, that works too. Let's see here. Jose Guzman says SHNY and Dole come up as BOM securities. Passive, that's the strategy I'm doing. Didn't get how did you minimize the risk? Dollar cost average into 3x leverage ETFs. What's yours? One thing I like doing with 3x leverage ETFs, I know it's risky, but I like if like on a day like today, if you expected the market to soar, I like buying into the UPRO fund for the S&P 500, like call options, and then making a nice quick profit. That's
Yeah,
it's worked well for me a few times.
yeah. If you have confidence that markets are in the middle of moving, jumping into a triple leveraged is a good way to gain quick exposure. But I would never hold on to one of those for more than a few days or like a week or two.
Yeah, yeah, because they do move a lot. And there's the TQQQ one for the Nasdaq also.
I think that's the one that pretty much just goes straight down. Uh,
The
Hang on. One of the Nasdaq ones has vastly different performance than the other one. Hang on just a minute. I can
look,
tell you
it's
in
like
just a
the
minute.
triple Qs, like it's like a 3x. Because I did make a nice profit on one option pretty quick. I want to say in June we had a nice run up in the Nasdaq. Oh, Huffman's here. He's saying SQQQ.
Yeah, it is the SQQQ. It pretty much just goes straight down because you know how stocks always go up. That whole premise where
Hmm.
because of inflation, the value of dollars go down, so the dollar value on stocks just go up and up and up.
Hmm.
So the Nasdaq is just expected to continue going up and up, and it has for the last decade or so. And if you short the SQQQ, let's see, it's down 21% in the last month. It's down 40% in the last year.
Hmm.
It's down 93% in the last 3 years, and it's down like 98% in the last 5 years. So if you just short it and wait, it will eventually grind down to like nothing.
The
But
TQQQ.
yeah, the SQQQ.
Oh,
Um,
SQQQ. Yeah,
yeah,
because the
right.
TQQQ, predictably, I mean, as expected, it peaked in 2021 when everything peaked, and then
Yeah.
it fell. It hit its low point actually at the beginning of this year, and it's gone from 1764 to it was all the way at 4402. So just buying in, like if you had bought options and held them for a few months, you would have made a nice profit because it's up. between January and July, it was up like 176%.
Yeah.
But the SQQQ is the inverse of that. Yeah, so that's down 65% year to date.
Right. And so if you short both of them, under normal conditions, the short couple will lose value, and so you'll gain value.
Mhm.
And unless a trend happens, if a strong trend breaks out, one side of the position will lose more than the other side gains, and you
Mhm.
will lose money. So it's not like a risk-free strategy or anything like that. There is no free lunch.
Yeah, for sure, for sure. One thing, a little off topic, but you mentioned inflation. I actually want
Yeah.
to pick your brain on this. So everyone says, "Oh, inflation's caused by government spending and this and that," but no one's been able to answer for me. So the government's been spending a lot of money for a long time, obviously,
Yeah.
and from like after the big '08 crash, the government pumped a lot of money into the economy, but we didn't see inflation for those 10 to 12 years.
Right, right. So this comes down to a difference between fiscal policy and monetary policy.
Hmm.
So you know what? I'm going to Google this because I don't want to screw this up.
Yeah.
Because I'm about to tell you one is one way and the other one is the other way, and I'd really rather not get this messed up.
Yeah, I
Fiscal.
figured you would definitely have,
No, I understand how they work, but I don't want
yeah,
to swap the words.
right.
Okay, so monetary policy is primarily concerned with the management of interest rates and the total supply of money in circulation.
Hmm. So the
S-
Fed,
That's the Fed.
yeah,
Fiscal policy is our federal government,
hmm,
and they are two very separate entities.
right.
So the inflation it's very, very difficult to blame that on fiscal policy. The mass media and the politicians, they all like to blame each other for government spending, but the government doesn't actually control the supply and demand of money.
Hmm.
That's monetary policy. That's the Fed.
Hmm.
So the Federal Reserve is literally driving the bus, and over the last year and a half, we found ourselves in the ditch. And everyone's trying to point fingers at everyone else, but I know Jerome Powell was behind the wheel when it happened. So it's definitely a problem that the Fed should have dealt with better.
Hmm.
So this is a very complicated topic, but I can give you my 2 cents plus.
Sure.
So when the pandemic broke out, the Fed responded correctly. They were supposed to juice the market to keep everything propped up, to keep what was left of our economy that wasn't shut down moving. Because the last thing that they wanted was like a grind to a total halt. They
Hmm.
needed some aspects of the economy to keep going, even though kids weren't going to school and a big chunk of the workforce was not going to work. So that was absolutely the correct move. However, about a year to a year and a half later, in 2021, in the fall of 2021, the unemployment rate fell below headline inflation. And that is when the Fed was supposed to take their foot off the gas, and they
Hmm.
failed to for an additional 6 fucking months. I'm sorry if
Yeah.
there's children listening, but those 6 months are absolutely 100% to blame for our current situation.
Really? So if they started
Yeah.
raising them in August instead of like February?
Yes, if they had started raising them in August when they were supposed to, instead of dilly-dallying around for 6 extra months and not even talking about it until December,
Hmm.
we would not be in this mess. The last year and a half would not have been painful, nearly as painful. It would have been painful. They would have had to raise rates, just not as fast, as hard, or as high.
But then on the flip side of the coin, they've been raising rates for
Yeah,
like a
they
year and a half now, and
right.
it feels like it hasn't even made a dent.
Yeah, so well, it's like this. Everything they do has lag. So
Hmm.
there's a delay time between the indicators the data they collect and the indicators that they use to look at. And then there's also a delay time between the action they take and the effect that it has on the economy.
Hmm.
So there's two lags there. And so the data they get's like 1 to 3 months old. And then if they decide to slam on the brakes or hit the gas, it takes like 3 to 6 months for that to really wind up or wind down.
Hmm.
So what you're seeing is them having to slam on the brakes too hard because they reacted too late. If they had eased off the gas in the August of 2021 or maybe September, right in there, they wouldn't have had to raise rates at a record-breaking rate, and they would
Hmm.
not have inverted the yield curve so hard. Uh,
Interesting.
yeah, it's this whole thing, like their first reaction to the pandemic was beautiful, exactly what needed to happen.
Mhm.
And then I don't know who's to blame, but they just got stuck in this mode where everything's perfect and they could ignore inflation for those 6 months.
Yeah.
So a lot of people like to blame the supply glut or supply shipping problems, and I will tell you 100% of the time, 100% of inflation is always caused by monetary policy. It is a fraction, and they have infinite control over one side of the fraction. Perfect control. They can decide how much money's in the system, how much money's not in the system. They have total control over that, and inflation still happens. So you have to blame the person with infinite control. Who's driving the bus? Jerome Powell.
Hmm.
Now he's done a good job. Once he made the decision to react, he's done a fantastic job since then. But
Hmm.
that 6 month delay was a big problem, and I think it was just they couldn't come to terms with the fact that they had kind of overjuiced everything a little bit. And
Hmm.
by slackening off, they would have been sort of an admission of that there was a problem, and also an admission that they had made a mistake. And so by the time the end of December came, and I was freaking out because I knew they were about to make some sort of rate hike announcement because I was watching inflation go higher and higher above unemployment. And
Hmm.
when that happens, they're supposed to react. So the Fed has two public mandates, and they have a secret mandate that I probably shouldn't talk about. So the first public mandate is to keep inflation low, and the second mandate is for maximum employment. Okay, so maximum employment for them, that means 5 to 6% unemployment. And low inflation is exactly 2%, or like within a half percent of 2%. So they're happy with
Right.
like they're happy with like 1.7. They're happy with like 2.3. So they're happy around 2%. So
Yeah.
what's unemployment right now? Is it in between 5 to 6%?
It's like 3.8%, isn't it? Or maybe 4.
So they are not going to be able to fix inflation until they get unemployment up above 5%.
Hmm.
That is the hard truth, and so they need to force a short-term recession, or we're going to be stuck with years of stagflation.
Yeah.
And that's just where we're at right now. I need Jerome Powell to cause a stock market crash. I need at least one industry to break,
Hmm.
and I need us to have a short 6 month recession so that we can actually have a recovery and have a real monetary correction with our dollars.
Yeah.
And that is what it will take to fix inflation. What they're doing right now is just going to cause stagflation unless something breaks. I'm hoping something breaks so that unemployment will spike and then go back down, and it will fix the inflation issue.
Hmm. I mean, they do say that it's already started to come down, but the funny thing is, because like we've talked about, I mean, I majored in this stuff too, but
Yeah,
there's a part of me that sees like reality, like on the ground, and that also understands the theory. But like when they say it's coming down, and I still go around and I still see stuff going up, I'm like, it's not coming down at all, you know?
yeah, yeah. Well, a lot of times the mass media, they don't understand that inflation. They changed the definition of inflation. So back in the 70s,
And recession too.
yeah, and recession. Oh
Yeah.
yeah. So back in the 70s, the word inflation meant the rate of change of the value of money. And now it means the rate of change of the rate of change of the value of money. And it's extremely confusing to people who don't study macroeconomics,
Hmm.
because when he talks about inflation going down, he's not talking about prices coming down. He's not even talking about the rate of change of prices going negative. He's just talking about it's going to stop accelerating.
Hmm.
That's all he's saying. So everybody's super confused about this because they don't actually understand macroeconomics, and the language that the Fed uses, it's like a whole nother set of vocabulary.
Hmm.
It takes 3 or 4 months of a macroeconomics class for it to really sink in. Oh, passive investing ideas, passive earning
Join.
ideas.
Yeah.
Excellent.
Welcome.
Thank you. That was the closest I could get to
That's
passive
fine.
earnings. The handle, passive earnings. I got the handle, so I was like, okay, let's go
Oh,
with it.
it's a good one. Yeah, it's a good one.
Thank
I
you.
would turn my camera off too, but my screensaver is still the book title that I'm supposed to record part 2 to 4 of.
I'm eager to hear that.
Yeah, it's coming soon. Anyway, so let's go back for a second because I think we had a good question up here about So we were talking about the leveraged ETFs,
Yeah.
and yeah, you were talking about how do you minimize the risk? Let's see. Oh, and then you mentioned SOXL and TQQQ. You're doing a video on that. Is that right?
Yeah, I totally do not mind if you read my Seeking Alpha articles and then use them in videos. I don't mind that at all, especially if you name drop me and recommend to your viewers that they subscribe to me.
Of course, why not? Yeah, giving credit is.
I
I've
don't
done that before. I read one of your articles on here.
Yeah, I don't mind the free advertising. If you want an explanation for the erosion, I explained that pretty well in the TQQ SQQ article. But you were asking about how to minimize like the risk.
Yeah.
So let's see. Specifically with that article, I think I talked about going heavy in SQQ because it goes down faster than TQQ. And so if you just plain want better returns, but you don't want to minimize volatility, you can just lean heavy into that one. But if you want to minimize risk, so there's a few different ways to look at risk. Pairing the two couples together will minimize your volatility, but it won't necessarily minimize your risk. So something that a lot of finance guys don't understand is there's a difference between volatility and risk. When you get into portfolio management theory, for them, volatility is risk. So it's a very confusing dialogue to have with somebody about this term because the term risk means different things to different people. So one of the ways that I'm mitigating some of the risk is by coupling the two together. And so anytime there's a change in one or the change in the other, they both feel the same change, except over really long time periods where there's strong trends. Like let's say the underlying enters a really strong trend for like a month or 2 months. One side of the couple will end because they're both short. One side of the couple will grow in value more than the other one. And so you will be able to rebalance the position. So that way you will end up selling the side that ideally you will sell the side that is overvalued and buy some of the side that is undervalued. And then hopefully, cross your fingers, it'll move back in the other direction. And the side that used to be undervalued that you just put weight into, well, now that becomes your overvalued side. And you're going to sell some from out of that side and dump it into the undervalued side. So this concept works a lot better where you're overvalued and undervalued on non-triple leveraged ETFs. But on triple leveraged ETFs, every time I do the math on them, they're pretty much always stuck at 50-50 correlation for minimizing volatility. So I did not have a good answer for how to minimize risk in general, other than to watch the QQQ like a hawk. And if the macro environment turns really hard so that it looks like the QQQ is going to enter a strong trend, leave. You can take this trade back up some other time. It'll always be there. If you are convinced the QQQ is going to be in a range for a while, that is when you take on this trade. You don't just blindly take it on like all the time. So you have to have some sort of a macro thesis that's guiding you that tells you, I think the NASDAQ is going to trade in a range for the next month or the next 6 months, or the economy's just in general pretty stable and it's not going to have really hard swings up or down. I'll take on the trade. Right now would not really be an ideal time to take on the trade, because if like the macro changes really hard over the next year, and mostly what I mean right now, I mean over the next year, we are entering a period of elevated volatility because there's a lot of uncertainty and indecision about what the Fed is going to do with rates, especially after what happened today, where people were expecting maybe one last rate hike, maybe not one last rate hike. And we got this announcement that they weren't going to do a rate hike now, but we're going to go ahead and plan in like another maybe 2, maybe 1 rate hikes next year sometime. So that caused a lot.
Article, by the
yeah,
way.
go ahead and scroll. Go ahead and scroll down.
Yeah.
There's a section called "Why They Erode," and that section's probably worth your audience hearing, because this is also a life lesson on why you should not be long a leverage ETFs over longer time periods. Like you should just not hold these like on the long side for more than a week or two, because they just erode. So I'm going to let you read that out loud or something, because it'll feel weird.
Leveraged assets decay because they have a higher beta than the underlying their behavior is tied to. Because they are designed to move according to the daily price action of their underlying, they are unable to maintain correlation over longer periods. When an asset goes down by 20% in one day, it would need to gain 25% on the following day to return to its previous value. This problem is enhanced during more violent moves. A 33% drop would need a 50% gain to return to its previous value, while a 50% drop would then require a 100% gain. Very interesting. So, and then you go into the QQQ. If it goes down 10% in one day and then up by 11.11, oh wow, you break it down too with the math. With these returns, QQQ will return to its original value. Wow, look at that. And then the three times leverage ETF in response would land at a much different point. Wow. Interesting.
Yeah, a 2-day move causes a huge erosion.
Mm-hmm.
Like the bigger the move, the bigger the erosion.
Yeah.
And if you're short, that erosion is in your favor. That's the whole point of shorting both assets. But the risk, if you scroll down a little further, you'll see the risk becomes pretty clear. If you look at the 5-year chart. If you scroll, just keep going.
This one.
Yeah. Take a look at what the TQQ did for like the entirety of 2021. You would not have wanted to be short the TQQ during 2021. It was just ripping straight up.
You would want to do call options all year.
Right. And so this is sort of one of those trades that you're going to take on under certain market conditions. When you think it's just going to basically trade sideways-ish for a while, and it's not going to enter a strong trend in either direction. I hope I answer your question, passive earnings ideas. And do you have any other questions?
This does answer my question. So what the only problem that I was seeing, and you mentioned in that specific paragraph, was what I was thinking is these are not two correlated ETFs. So it's not like if TQQ is going $1 up, SQQ will go $1 down. It's not like that. It even not in percentage. So you can see the returns here even.
So they're both highly correlated to the same underlying, and they both follow the opposite rules. So they're both pretty correlated to each other, but the other term is co-integration. So they fall out of co-integration during trending markets, and during ranging markets they stay in co-integration fairly well. And during periods, this is like a statistics term. During periods where co-integration maintains, the pairs trade earns money. When the co-integration falls out of correlation, those are the time periods that it's losing you money. So a $1 move in the underlying will force the TQQ and the SQQ to move by basically the same amount on a daily basis. But over longer time frames, the differences add up, like a penny here, a penny there. And you can see, like, the entire year of 2020-21, you do not want to have been short the TQQ during this bull market. You'd be underwater on your position by way more than what the SQQ would have earned you. So that is the primary risk, is trending markets. There are other mechanical risks, like it's possible that the ETF could fall out of sync with its underlying. But that's going to happen like once every 20 years or something. And I don't mean per ticker. I mean in all of the 50,000 stock market stocks. That's going to be such a rare black swan event that it's not really a real risk. But it is possible that, like, I don't know, the guy managing this has a heart attack in the middle of the day. And, like, all sorts of other things can happen. But the real risk is trending markets. You don't want to take a double short pairs trade in a trending market. You want to do it in a ranging market. It might be really good on like gold or something. Earlier, somebody mentioned that there was a Shiny and Dole. I think the coach brought it up, and they were both triple leveraged on gold. Well, gold doesn't really move that hard, and over longer time frames, gold basically maintains its value. So I need to start looking at double shorting both gold ETFs and see if that's even worth like my time looking at.
One more observation from my findings. I've been selling cash secured puts on SOXL and TQQ. So what I've noticed is selling cash secured puts, usually the DT usually should be around, for 30 to 45 days is what is recommended by, most of the.
If you want to maximize your theta, that is what a lot of people recommend. Yeah.
Right. But with the leverage ETFs, I feel like even 1 week is a lot
Okay.
of how much they swing. So what I've noticed, and the video that I was talking about was around the premises that if the math is simple. If the moving average, the 10-day moving average is below 50-day moving average for TQQ or SOXL, in both of these cases, then you're not supposed to be selling cash secured puts. Basically, selling cash secured put, if anyone in the chat does not know, it's a bullish strategy, right? Like you are thinking that the price will go up.
or neutral. It could just be neutral and you have
or
yeah
exactly. So but in the other way around, if what I've noticed, and again, like I only tracked for last 3 years or so, if the value of a 50-day MA, like moving average, is above 10-day moving average, in both of these cases you should not be going selling cash secured puts on this. Then
right.
forward calls would be the source to generate some income. So that's the thing that I found. But
So are you a value investor, or have you studied value investing much?
I have, yes.
Okay, so I really like, if I used to sell cash secured puts, I did it for about 4 months, and then I gave up and switched to front put ratio spreads. But I only take those on every once in a blue moon. Like if someone's going to pay a dividend or something, I'll take on one of those sometimes. But with selling puts, the one thing that I really pounded into myself was to try to find markets that were in a bottom, and to only sell puts on things when they're already undervalued, and that gives you an extra margin of safety. So for example, right now I'm involved in a company called High Tide, and if you put
talked about that a lot.
yeah, and Coach, if you'd pull up their ticker,
Yeah.
I can explain to you why I'm convinced they're so undervalued.
Yeah, that would be great. Yeah.
They're basically facing a whole bunch of catalysts, and so I've been thinking about doing some, let's just call them irresponsible options trades, where I like sell a deep in the money put and then take all my premium and then buy calls.
Now they're in the cannabis business, right?
Yeah, they're a retailer. They don't actually grow the plant. They're like a Starbucks, where they just buy it off a wholesale and then they sell it as a loss leader. So their goal is not to actually make money on the flower. They're just trying to get you in the door. And while you're in there, they're trying to make money off all the glassware and the accessories. So everybody else on the planet is trying to make money by growing the plant and selling it to customers. And High Tide is trying to make money by selling you glassware. And that is the core of their business. So the reason I love them so much is they put a downward pressure on the wholesale price of cannabis, and they are single-handedly driving everyone else in Canada out of business because no one can afford to sell it for below the cost of production. This quarter, they announced that they just reached free cash flow positive. And so they're currently under an extremely bullish situation. They're also facing rescheduling as a catalyst, because as soon as rescheduling hits, they get to start expanding into the US. And they're facing safe banking as a catalyst. As soon as safe banking hits, they can start selling cannabis to online to Canadians, because they trade on the NASDAQ. So they have to follow the rules for both countries. It's kind of a headache. So it zoom out to the 10-year chart, and you'll understand why I'm telling you this company is currently undervalued.
All right. Go back here. I was just looking at this the other day, actually, because I know you've been talking this up a lot.
Yeah, well, the CEO is also really competent.
Good. So it only goes back to 2018 or 2019.
Yeah, that's when they started trading publicly.
Yeah.
So this company goes down into troughs, and then when the sector goes up through the roof, boy, do they go up. They have a very small float. So I'm hoping to make a big chunk of money over the next, I don't know, 4 to 6 months or something. At some point, this thing is going to squeeze really hard. But the point is, this is the type of thing that I would sell puts on. because volatility is currently really high and it's bullish and it's facing catalysts and it's undervalued. So this is the type of thing I would be looking for puts, because it has all the characteristics, because I'm bullish on the stock. So that's my one piece of advice for selling puts is find the thing you're the most bullish on and sell puts on that.
Got it. Okay.
If you were going to do a trade like tomorrow, like what put would you pick? Like what strike price would you pick?
Well, the lowest strike is $2.50, and I would just go all the way out in time that I could, just to give you
basically
extra.
The idea, like they expire worthless, you keep all the premium.
Yeah, and you get your $250 back.
Nice. Oh, so you've already like covered the cost of like buying into the stock then?
Yeah, well, when you sell the put, the broker locks up your cash and then they hand you the premium, and when it expires, you get your cash back.
Right.
But so the other lesson is you only sell puts on companies you actually want to own, in case you get exercised.
Yeah, that's important.
yeah. Getting exercised is a real problem if you are just selling puts for income and you don't actually want to own the asset. That's a huge problem. So
That's
don't
what Warren Buffett does. I don't think everyone knows about that, but like the famous example with like Pepsi or Coke, he sold a bunch of puts and he made like a $5 million premium right up front.
Yeah.
Yep.
Was he forced to buy it?
Well, he doesn't mind. If he is, he gets in at what he thinks is a great price.
Right. That's true. That's true. He just only does it on things he loves.
Right.
That makes sense.
Yeah. But when you're Warren Buffett, you can collect $5 million up front, just like that.
Yeah. Well, he was buying the dip on Coca-Cola during the 87 crash for a reason, is because he understood what a good business that was, and he saw it as being undervalued.
Mm-hmm. So, all right. Well, that sounds good. So, passive earnings ideas. You tell us a little bit about your channel since you're on.
Yeah, sure. So I have invested in blue chip stocks, and as you can tell, some of it is in SCHD. I bought the hype a couple years ago, but still in green. And then came across quite a few videos and channels and learned a lot from the market makers, about selling cash secured put, how you can generate some income as well on the side, to accelerate the overall portfolio value. So that's what I've been doing. I'm selling cash secured puts on SOXL and TQQ covered calls. I got in good. I got in TQQ with an average price of $22. Now it's, I think, trading around 37. So my covered call options are still around $42, which would still double the gains. And then on the cash secured put sides of SOXL, couple of options. I'm deep in the money. That is where I want to see how can I hedge, and that's where that question came from. How do I minimize my risk? But overall, that's a journey I've been sharing on my YouTube channel as well, with SCH.
Do you have a link to your channel?
Sure. Yeah, I can send it over.
All right, great.
So you're already selling puts. Can I show you a front put ratio spread, or are you already familiar with them?
You can surely show me. Yeah.
You want to take the screen? Go ahead.
No. Hey, coach, pull up my article on Enphase.
Okay.
And then just scroll all the way to the bottom. I'd ignore the article. Just go all the way to the options trade at the bottom.
Okay. Enphase. Haven't heard a mention of Enphase in a while.
Enphase, yeah, I watched a video about Enphase just yesterday, so everything is lining up.
So Enphase faces a lot of short-term headwinds, but in the long run, they have a lot of long-term tailwinds. The cost of solar panels being really cheap is really good for them.
What date was the article?
Oh gosh, let me scroll.
Oh, here it is, August 11th.
Okay. I just know this is one where I showed my readers a front put ratio spread, and anyone who's already selling puts, I got bit one too many times, You know, you're picking up nickels in front of a steamroller. You know that eventually it's going to hit you. And I just got hit one too many times. And I'm like, you know what? Forget this. I'm never selling empty. I call them empty because they're not naked. I'm never selling empty puts. I'm never doing just puts. I'm always going to pair it with a long put. So I sell more puts at a lower strike than what I buy. And then as the price goes down, the put that I'm long gains value. And this ends up pushing my total break even on the trade way below the price of the puts that I sold. And so you can end up buying buying shares for much cheaper than what you actually paid for them.
I would love to hear about that, but my current strategy is I do not let them exercise. So I roll them over, roll up most of the time. But yeah, if there's any other opportunity that be nice.
I just got bit one too many times, and I was tired of always having to roll. And because sometimes when you roll, it's really disadvantageous, and you don't get your money back for months if you just keep having to roll out and down, out and down. And eventually I got so frustrated with it that I was like, I have to find a new strategy. So this is what I settled on, mostly because I'm a value investor and it gives me a chance to push my break even down below the strikes of what I was selling. Are you able to find the article, Coach?
I did, but the paywall came up.
Oh no, the paywall.
Yeah, I do have a login for something, but yeah, I would go to another browser, but it's this is linked to my Chrome, so
okay.
Yeah.
I guess you can have me share my screen.
Yeah, go ahead. Go ahead.
I don't really know what I'm doing, but I'll try to figure it out.
Yeah. Oh, I found your channel, Passive Earnings Ideas. Cool. I'll subscribe to you. Anyway, well, thanks for coming on. I mean, you don't have to stay on the whole time if you want to drop.
Of course. Thank you. It was nice.
Well, right, I'd like to keep him on so I can ask him if he understands this. I want to show him the strategy, because if he's already selling puts, I might as well show it to him.
Of course. And meanwhile, while you pull it up, why SOXL or TQQ, right? I think the two main, because I started initially investing in dividend stocks. So my main goal was, and value investing mainly, but my main goal was to, test the waters of high volatility stocks or ETFs as well. And what I learned is that even rolling these options out for SOXL or TQQ gives you a lot of premium. What I mean by a lot is at least 3 to 4% every single month on return on investment. So having a even by rolling these options, I average about like 4% return every month. It's nothing to brag about, but at the same time, not getting exercise is one thing that I really think that can help.
Yeah. So generally, if you're getting supernatural premium, you are probably taking on risk that you're unaware of. That's my general thought on that. If you're getting premium that is so high and you cannot explain why it's high, that would be a red flag to look for some sort. Like, what are you missing? Now, maybe you're not missing anything, and it's just like the cash cow that's ready to pay you. But I would put extra scrutiny on anything that is too good to be true.
Right.
I don't know why it's not sharing my screen. It was there for a second.
It was, and then it disappeared.
Maybe I need to figure out what I'm doing a bit more.
But yeah, overall the strategies, I think, as you mentioned, with wherever there's big reward, there's bigger risk.
Yeah.
So that's why, I try not to, let it get to the expiration date. So keep it around 10 to 3 days time, and 3 is the closest that I've been to the expiration date, and then roll them over or roll them up.
Have you tried selling things that expire the next day, like right into the close of the current day? So
I was looking at zero DTE, like day to expiration. options, but those spreads are like too risky for me. Honestly, I feel even with 95% of probability or chance, those are still risky. Even with the SPX or even with SPY, I feel like these are still risky.
I've been bitten stepping across the spread so many times. I don't even want to talk about it. I don't even do market orders anymore. Everything is a limit, and now it's to the point that like I'm missing out on trades because the market rips away from me, and I'm busy trying to type in a limit order. But I'd rather face that situation than ask the SPY to give me a market order, and then they just wreck me for like a bunch of money that I wasn't asking to lose on the fill.
Mm-hmm.
Yeah, spreads are scary.
Yeah. I'm trying to figure out how to share my screen, and I'm just incompetent. I think that's what's going on here.
Here, let me see. I doubt that, but let me see. Oh, here it is up here.
Okay. So here is it scroll when I scroll? It looks like there's a delay.
Yes.
Okay. So here's end phase. When I wrote the article, it was trading at 139. And I had calculated fair value of this thing at about $103 per share. So if you buy a put that's basically at the money or just outside of the money, like lower in strike than the current share price, and then sell puts below that. And so the strategy that I always use is however much you just paid for the put that you're long, you want to pay for half of that with one put and then the other half with a pair of puts. And what this ends up doing is it ends up pushing the break even all the way down to, if you look down at the bottom, the break even is at 56.20. I'm not sure if you can see it because the script might be a little too small.
Yes, that part.
Let me control plus my screen. Let me do this.
Well, there, I just made it full screen.
Okay, so can you see me now, or do I need to make it? Let me make it even bigger.
I can see it.
I can see it, yeah.
Okay, so the put that I'm long, I paid $21.35 for, and I'm paying for that put because this is like basically a zero entry cost strategy, except for the money that gets locked up. I'm paying for half of that with the one that is a $90 strike, and that puts $11.68 back in my pocket. And then down below that, I'm paying for the other half by selling a pair. And these strikes were chosen based off of the value that they were going to give me in premium. These are not like, I didn't like, oh, I want exactly 70. It's more like I want it to pay me about $600.
Mm-hmm.
So that's how I chose these strikes. And the net result is you end up something with a break even that's just on the floor. And so the break even here on this trade is 56.20. So this trade refuses to lose money unless end phase goes from $139 a share below $56 a share. So the chance of getting bit on this thing is almost nothing. Statistically, according to the website, it has a 94.8% probability of profit.
Mm-hmm.
But from a value investor point of view, I already calculated the intrinsic value to be at about $103 per share. So if this thing falls below $56, I'm just going to be buying this thing with both hands anyways, because it's on fire sale. It's time to get rich, buy it on the cheap. So this is something I try to show every value investor, is because this produces break evens below intrinsic value. And so you can end up with an actual margin of safety while you're selling puts.
So would you let
site are you on?
these? Would you let these contracts expire?
So my goal on this trade was actually to get filled, and my goal was to get handed the 300 shares. So I would be getting handed shares at 90, and then more shares at 70. But you're welcome to just close the trade like whenever. So you can see here, I'm using optionsprofitcalculator.com.
Okay.
And so one of the advantages of the front put ratio spread is if you look up, you see that horizontal line between 136 and 140.
Yes.
If the share price of end phase goes up, you can actually close this trade out for a small gain.
Right.
If it goes down, you can usually close it out for a small to medium gain, unless it goes all the way to, like, I don't know, bankruptcy. because it's trading right now at 139 per share, and I think fair value is around 100. And if you look at where the money zone is, that this was going to make a max profit between about $70 a share and $100 a share. And so you produce this really wide zone of max profit. And so that max profit zone, it correlates to the in between the 70 and the 90. So these $20 between these two strikes, this is your max profit zone. God. So if you want to try to bullseye a value later on, like months from now, you can set up a buy where you're going to end up getting exercised on shares at a really cheap price. And if you don't get exercised, you at least get to walk away with $263, which is really bad if you're looking at this on like a returns point of view. You know, you lock up a bunch of money for like more than a year, and you only get $263 out of it.
I was about to ask that, like, is it like intentional for the January expiration?
So I chose January because my thesis is based on macroeconomic factors, and those take like months to play out. So I think end phase is going to keep grinding down because I think we're facing a recession. If the recession never happens, then at least you don't lose money on the trade. And so it may never fall below 100. You know, it may fall down pretty close to fair value, and then people step in and buy that dip, and none of this ever gets filled. It's quite possible that it never falls below 90 and never ends up in the sweet spot. But I just really like this style of trade because you end up pushing the break even down so low that your odds of actually losing money is really low.
True. Yeah, this is good.
But you know, it doesn't necessarily produce amazing returns. Like if you add up the total amount of cash that you lock up, earning $2,700 is not super attractive. What is attractive is getting filled on end phase at a good price months from now without having to stress about it or worry about it or time the market.
True.
This is also good for dividends. If you know a company is about to pay a really fat dividend, you can sell a put and then you can buy a put at the money and then sell 2 puts or 3 puts down at a lower strike. And then when the dividend gets paid, the implied volatility will crush and the value of everything will collapse. And you'll be able to close the position out for a pretty significant gain because the value of the puts that you sold were mostly off of extrinsic value. And as the implied volatility crushes, their value will collapse as well. And so as you can do this on dividend plays, like if a company pays a fat dividend, like, you know, like Zim Integrated Shipping pays like
it was 100% at one point.
Yeah. You pay like a $5 dividend. Well, you set up a front put ratio spread because you know it's going to go down by $5. That is not in question, right? It's going to go down by the dividend. So you figure out what the dividend is ahead of time, and then you set up your money zone where you make the most profit, like, you know, 30 to 50 cents below the dividend. And then when they pay it, it's going to drop the price on Zim right down into your money zone, and you're going to close the options trade on the day that it falls, right? So everyone else is like messing around trying to snipe the dividend with their shares and all that silly business, and you just get to close for a huge profit as IV crushes. I hope that made sense to you. Did that make sense to you? Because that's an IV crush play.
That does make sense, and I think that's one of the factors that I was saying initially, to never sell cash secured put more than 7 days out because of IV.
Yeah. IV can be terrifying if you don't have a good forecast for what it's going to be later on. And no one can tell the future, so it's always wise to be cautious.
Exactly. Yeah. But this is a good play, I think. I'm gonna use this.
Yeah, you're totally welcome to steal all my ideas as long as you talk about me a little bit. I'm trying to get to 50 subscribers so that I can hold my own live streams, especially if I can get a hold of a camera that is willing to work at the same time as my microphone.
Yeah. Well, you could do the faceless thing. You could just talk like this.
Yeah, I'd rather show off my face so that I can build trust with my audience.
True. Yeah.
I'm a brutally honest kind of guy, and I have nothing to hide, so I might as well just be on camera.
Yeah. Well, I think I was subscriber number 6 or 7.
Oh, thank you, thank you.
Yeah.
I hope some of the, like, I don't know how many people are watching right now. I hope some of the 53 people watching are interested in hearing me talk in the future and
And
would like.
I have all my subscriptions public, so,
Cool,
anytime
cool, cool.
anyone looks through them, all my
Heck yeah.
subscriptions are there. Yeah.
I was thinking eventually I might do an iceberg on markets, and in order to do that, you wanna bounce the ideas off of someone, so I might try to have you on my channel,
Yeah.
where I'm explaining to you this iceberg on trading and investing, and we're just gonna go deeper and deeper, and by the end of it, it's just gonna be all conspiracy theory.
Oh, great.
Yeah, it'll be interesting.
So you're under Blake Downer EIT, right?
Yep, Blake Downer EIT.
Okay.
I'm thinking I'm gonna start doing, like, Q&A about specific tickers, 'cause
Mhm.
if you look me up on tip ranks, I
Mhm.
have a shockingly higher, like, rating than not every other analyst, than many other analysts, and I've been saying my entire life how those price targets are a joke, and those analysts don't know what they're talking about, and then I decided to, like, finally put my writing where my mouth was, and started writing for Seeking Alpha, and now I'm ranked on tip ranks.
Mhm.
And so I have proven to myself that I'm actually really good at picking out tickers and understanding markets. And now that I'm on tip ranks, I have verifiable evidence that I can show to the public and say, "Hey, I know what I'm talking about," or at least halfway know what I'm talking about. So I'm probably gonna do live streams where I have the audience come on and just ask me about companies, and then you're gonna watch me research them in real time, and see what it takes. See what do I look at when I decide if a company's a buy or a sell? What does it take to
Mhm.
find intrinsic value? Stuff like that. A huge number of retail participants don't really understand how to value a company. Like most Americans can look at a car or look at a house and tell you within like 5 or 10% what it's worth, but they could never look at a company and tell you what it's worth. They have no clue.
Right. Very true.
Just one thing I noticed with YouTube, and I would ask the coach the same question as well. What my understanding or um, learnings are from YouTube, it's most of the folks that you see and your as a viewers or subscribers, they want to know like the basics, right, to the core, where you need to break it down, make it as simple as possible for them. Um, then uh, then most of us could understand. So it's the audience is not, we cannot just target one specific group. That minimizes the audience, graph, or you can call it the demograph
Yeah,
overall.
it's definitely a challenge because if I'm gonna or the coach or any of us is gonna do like an educational thing, we have to have our information entertaining enough for Hoffman because Hoffman has already heard all of this stuff.
Yeah. Well,
So
it's a
we
balance between
Yeah.
like I could be, like a professor and go into all the macroeconomic stuff, but I've got to make it entertaining too.
yeah,
Like when I
yeah.
did videos on just personal finance, I got like no views. I did videos on budgeting, credit card churning, just general like stock picks, things like that, and they got like no views until I started talking about dividend investing.
Yeah, well, there's a lot of boomers right now that are retiring,
Hmm.
and they all want to know about these dividend stocks they've been hearing about their whole life, and most of them don't really understand the mechanics of how they work, so they want answers.
And there's a general trend of not even just with boomers, but with all age groups, just of finding passive income and not working,
Oh,
retiring early.
oh yeah,
Yeah.
absolutely. The
Hmm.
FIRE movement is growing momentum all the time.
Hmm. So, well, anyway, did we talk about rec shares enough? I know that's what the video was about, but I see a lot of
Their
comments.
their performance should basically be identical to YieldMax.
Yeah.
That's the conclusion we come to until we have more information about their actual holdings or their performance, like after a month of trading.
Hmm.
I don't really have much more to say about them other than I expect their performance to be pretty much the same as YieldMax because they're both doing the same strategy.
Hmm. Well, sounds good. Yeah. So when do we know when the first funds are supposed to go public?
I don't know. I think they're just proposed the idea for the SEC to look over. I don't know how long it's going to take for them to approve it or any of that stuff.
Right. Yeah, I think there's a couple of other ones. There's going to be some stocks that YieldMax doesn't offer.
That could be a potential, an arbitrage opportunity for them to be the only game in town for those tickers.
Yeah. Shares. Let me see.
I'm going to go ahead and stop sharing.
Yeah.
Oh, it's all black. No one can see anybody.
Oh, I turned my. Here we go. Yeah.
There we go. Someone's got to entertain the crowd.
Right.
Coach, can we call out some other YouTube channels that are making good videos, good content around YieldMax? Because that was the topic of this video, and I see quite a few, creators. And one I saw, Ethan. You probably have seen his channel as well.
Yeah, he's actually direct messaged me.
Okay.
Mhm.
Yeah, I've seen.
And some of his people, believe it or not, I don't think he was aware of it, but some of his people are selling copy trades, which those of you that have followed me for a while, I'm a huge fan of copy trading.
Hoffman, no.
Yeah, and so I just basically told him, I said, hey, you have people, trying to sell stuff in my Discord, and he wasn't aware of it. So I guess he's gonna, get on top of that. But I think copy trading is like super scammy. So anyway.
A rather large portion of the financial world is scummy snake oil salesmen, and
Yeah.
it's really hard to find people that are honest.
Mm-hmm. I tried so hard. I did get one copy trades person on a live stream. You probably remember that one.
Yeah,
we had fun with that one, but a lot of them, they won't come on.
Well, they know what's going to happen when they're confronted with, please show us how this works, or show us your strategy, any of that.
Right.
But my last question, I've been asking quite a few questions here, but my last question I wanted to discuss is specifically for YieldMax ETFs. Is this wise to invest, put in $600,000, although that probably make, very less chunk of the big pie that someone owns, but going all in.
Depends on your total net worth. I mean, if that's all your net worth, I definitely wouldn't do that. But if it's like 10 or 20%, possibly. I think even Jay said that.
Okay.
So I would also not recommend putting everything into a single ticker, but I also want to point out I'm a hypocrite because my entire brokerage account is in high tide right now.
Mm-hmm.
So with Tesla specifically, I could be wrong about this, but I expect it to erode at about 25% per year, and it pays a 50% yield, which is actually really good. Mm-hmm. So if you look at like buying an apartment complex, you might expect to take 10% depreciation per year on that, but it's only going to pay you like a 4 to 5% yield in rent. Mm-hmm. So Tesla pays much higher than its depreciation.
The only thing I noticed, I'm sorry to cut you, but the only thing that I noticed, this 50% of the yield that we are seeing on their website, as well as with the numbers, most of it came when the Tesla stock price was around, around $20 or so. So compared to that translates to, 50%. But now, since the stock price has gone down to $14 or so, it's the ETF price is not half, but the dividends they are paying, and that's because of the volatility and all of that. But don't you think like NAV erosion is real deal there? Like 25% return is expected from Tesla overall?
So I think that's going to maintain the same behavior that it's had been, only because I have faith that people will continue arguing about Tesla. So the core root of where the cash flow comes from with Tesla is the implied volatility from the options market, and implied volatility is really a measure of disagreement. And so as long as you have millions of people arguing about whether or not Tesla is going to the moon or not, the yield will always stay, like in that 40 to 50, maybe 60% range. And it will definitely vary from month to month dramatically. But the net result, like over many months, every time I do the math, it's in the high 40s or it's like 49% or something. It's pretty close to 50%. I think I was telling Coach the last time I was on, if you invest 100 grand into Tesla, it'll pay you 50 grand in the first year. But a year from now, it'll only be worth, let's see, 75,000. And then in the second year, it's not going to pay you 50 grand anymore. It's only going to pay you like 38,500, right? So then in the third year, it's no longer worth 75,000. Now it's worth what, 58,000, and it's going to pay you about 32,000. And so sometime during the third year of ownership, it will have paid itself all the way off. And now you have this ever slowly depreciating asset that's just going to pay you for the rest of your life. Now, what are you going to do with that money? Because remember, it's slowly going down, right? It doesn't pay you more every month. It slowly, statistically, on average, pays you less every month. I'm probably going to invest in things that I think are going to increase their dividends over the next 20 years. So I'm going to choose I don't know if you've ever heard of a company named Otis. They do elevators. Odds are, if you have been on an elevator today at work, like you go into the office, it was made by Otis. They have a huge moat on elevators. They're basically the world's leading elevator company. They're almost the only ones that do custom elevators, and they consistently generate really strong returns. They buy back shares every quarter, and they increase their dividend all the time. So Otis is the type of company that I'm planning on taking Tesla payouts and putting them into for long term. I actually don't really view Tesla as a long-term investment so much as I view it as a medium-term paycheck. Like it'll pay you real fat for a few years, and then eventually it won't pay you very much anymore.
Right.
So you had better spend that money wisely. You'd better buy things that pay more over time instead of more things that pay less over time.
But then DCAing into that would also not help then. But it will last longer, I guess.
Yeah, so if you take about half of your each distribution, right? Because if the math says 25% and 50%, if you take about half of each distribution and reinvest just half of it, if my 25% holds true and if yield stays at around 50%, then like several years from now, you should still basically have the same amount of money invested, and it should still basically be paying the same amount. Basically, I mean, give or take variation. But so if you just reinvest about half the dividends, you should maintain, that, like, let's say hypothetically you start with 100 grand. If you only pull out 25 grand that first year, instead of going down to 75, now you're still basically at 100 grand.
Got it. So then it makes it consistent, right? Like how much erosion that you're seeing, you invest that much every year.
Yeah, basically and I could be wrong on the 25%. It may be that some months you feel the need to invest more and some months you feel the need to invest less, but I suspect over the long run that it erodes at around 25%. And that's what I've been doing all my discounted cash flow calculations on to determine fair value for Tesla, is that I think it erodes 25%. And if you read my Tesla articles, there are ways to mitigate the erosion, but you have to know call options. Like you have to be willing to buy call options and short TSLS, or wait, you short TSLL.
TSLS is the 1.5 bearish one, right?
Yeah, it's 1.5 bearish. Oh, I see people looking up Otis. Yeah, Otis is a fantastic company. I expect it to do well for decades to come. Not financial advice, but I'm planning on eventually putting some of my money into Otis. It's just, you want to invest in companies that are solid earners, and this thing makes money, and they have a moat, and they're very low competition. How many other elevator companies do you think are out there besides Otis? And how much of the global market does Otis control? It's kind of disgusting. I don't know what the percentages is, but when I looked it up, it was huge.
So you think it's one of those dividend growth stocks, but it's got a kind of a low dividend percentage right now?
Yeah, it's what it's good for is what's called yield on cost. So
just like what's the other fan favorite, SCHD?
Yeah. So So Otis is going. I have confidence that Otis is going to pay a higher dividend 10 years from now than it pays now.
Mm-hmm.
And I also have confidence it's going to pay a higher dividend 20 years from now than it pays 10 years from now. I don't really know what that dividend is going to be, but I also have confidence they're going to buy back a lot of shares over the years. And so the net result of both of those compounding in your favor is that the share price just goes through the roof over time. You can look at, I don't know, look at like Tractor Supply Company, look at Foot Locker, look at Walmart, all of these retailers. Once they end up earning like 25 or 30% returns per year, you just have to be patient. Once they have their moats established, like Home Depot and Lowe's and stuff, all of those solid companies, they're going to keep buying back shares and keep slowly increasing their dividends for decades, unless something horrible happens to the company. Once a company enters buybacks and dividend growth mode, it's very hard to knock it out of there unless a competition shows up or there's some kind of sea change. Like, let's say you're a newspaper company and you get disrupted by the internet, or your name is Kodak and you get disrupted by digital phones. Unless there's some sort of heavy disruption, once a company enters the phase of buybacks and dividend growth, it's really hard for it to stumble. So Otis is just my number one go-to because no one's ever heard of them, and I get to look cool, like showing people this awesome company no one's ever heard of. And then now that you think about it, how many elevators in your life have you stepped on that were Otis's?
Do you see this one as a multi-bagger or just a stable play?
It's hard. So I think it has really good returns, and if I'm willing to hold it for like 10 plus years, yeah, sure, it could totally be a 10xer. But what I know Otis is, I know Otis is safe, and I know Otis will keep raising their dividend. And so this is exactly the type of thing that I would choose to dump my Tesla dividends into, in a hope of preserving like long-term wealth, right? To offset that erosion. Because I was saying, what if you take half your drip and put it back into Tesla? Well, what if you take your other half of your drip and put it into things with really good yield on cost? And Otis is not the only one of these. I have a list of like 30 of these good companies. Otis was the top one off the top of my head.
Right. Well, anyway, I think probably a good spot to end it there. Good live stream.
Sure. This is my chance to ask the audience to throw out some likes for the coach. And if you haven't had a chance to go subscribe to me, head on over to my channel and try to subscribe to me, because I need to get to 50 so I can host my own live streams.
Oh, is that the threshold, 50?
Yeah, it says I need to get to 50, and then I was going to try to live stream my way to monetization.
Oh, okay. It'll be interesting how long it takes you. It took me about not quite a year.
Yeah.
But it seemed like a while.
I'm going to try to talk about hot tickers. So we'll see if I can get more of an audience faster than that.
Yeah. Yeah, I've like I said, YieldMax has really blown me up, but my sub count's starting to flatline lately.
Yeah, well, people have moved on to, SQ or QQQY. That's the new hot thing.
Shares.
Rec shares. Yeah.
Yep.
And the macroeconomy. People are freaking out about the macroeconomy right now.
Right, for sure.
And coach, you need to update your thumbnails with an, scary burning fire, burning, home in the background, and those get the
yeah, to get attention, right?
The clickbaity titles as well.
All right. Well, thanks everyone for tuning in. Like, comment, and subscribe if you haven't already. Subscribe to Blake's channel, and thank you all again. Take care. Have a great evening.